Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
So double A, whoops, let me get us on camera. How about that? Hello, Michael Connor and double A here. Hey, are you feeling like about to blow up in your face, or do you think we're about to break through the resistance here and rally a little bit more through earnings?
Nobody
knows, right?
Yeah, does it have to be either or? Can we just kind of consolidate here for a while?
So we would fail and rally?
Flally, yes.
Flally.
I like that. It's a great term.
That's a good term. I'm going to use that, a rally subject to failure. Bear market rally. We got a lot to cover today. This is Cheat Sheets Live. I am your host and founder of Cheat Sheets, Mike O'Connor. And today, Cheat Sheets is a fairly cheap, actually it's free, a data service that you can subscribe to for free at stockcheatsheets.substack.com. There is a premium service, which is just a deeper dive. So if you're interested in trading individual company stocks, you do this subscription for a few bucks a month. So either way, we'd love to have you as part of the Cheat Sheets community, the ever growing. I can say, if I use percentage terms, it's a huge number, but only in percentage terms. I think we grew almost 10% last month. So I can figure that out.
That's big.
Well, 1 to 2 would be 100%. So it's bigger than that. But, I'll leave the rest to your imagination. And I got a fancy new layout that I don't think is going to work, but there it is. That's a new layout that the streaming provider has added to the mix here. But I think we'll do our traditional side-by-side one. Whoops. How about that? Nope. How about that? No. Do you like that? They've actually changed things. I think they got rid of the. Oh, there we go. There's the two stack.
Yeah.
How's the weather down there, double A?
Here in Denver, it's nice. Down here, it's nice.
Here in Austin, it's the best weather of the year.
Nice.
All right, today, chart reviews of market indexes. We'll look at relative strength across global assets. We've also applied the 10-factor quant analysis. If you are a subscriber, you've gotten all of that in your inbox. This will be a good verbal review. And I always try to shed light on the highly technical nature of some of the stuff by just kind of explaining it a little bit. So think of this video as a bit of a user's manual for cheat sheets, as well as our best attempt to form a directional hypothesis about the markets to the extent that that's possible to do. And we'll do a top-down analysis. Once we, grapple with the indexes, we'll look at U.S. sectors and subsectors. That includes what is normally a premium feature. We've distilled down all the ETFs to the 78 most liquid, most highly traded ETFs. It's a worldwide group, everything from Hong Kong to triple bullish banks. Hint, that's not a good place to be right now.
Right.
And then something else that we've developed as a new premium feature that we're going to share with everyone today is our new quantamental killers. This is where we take the best of the best from various stock research reports that are out there. Everybody has a different system for heralding their picks for bullish advancement. About a half a dozen of them that we subscribe to. And of course, we're not going to give their proprietary data away. That's not fair. But what I've done is taken the ones that show up repeatedly in these different, stock reports and run them through the cheat sheet system and then stack and grade them. So we can see, I think I call it like the best of the best. It's the fundamentally. So basically these subscription service emphasize the fundamentals. So think of Warren Buffett metrics.
Right.
And then cheat sheets, of course, is more like your Stevie Cohen, right? Technical metrics. So the combination, we call it quantamental killers. So it's the best of the best in the quantitative and fundamental space. And we'll get to that last, as well as leave you with 3 or 4 really actionable trade ideas for further research.
Great.
Sound like a lot to do, doesn't it?
Yeah, let's get to it.
Let's get to it. Okay. Everybody like this layout? Or I think I'm going to take us off screen for these charts. Okay. So we can see them a little better. So AC, this is going to be a recurrent theme, right? These are reversal patterns, right? I mean, maybe you could explain what this is a complex version of a classic reversal pattern called Head and shoulders, right?
Yeah, inverse, right?
Yeah, inverse head and shoulders.
Inverse head and shoulders, right?
Yeah, a reversal pattern. And so if you can imagine that the biggest hump, which would be the lowest low, is the head.
Mm-hmm.
And then these kind of, they're really double humps on either side of it. Those are, I guess, in one case, each of them higher lows compared to the low. And so the idea is we've gone from making lower highs and lower lows to piercing diagonal resistance. We actually kind of came back and retested that. And now we're making a series on an intermediate basis because this is a weekly chart of higher highs and higher lows. But what do you see ahead?
I see a confluence of resistance, both horizontal and diagonal, and
Yep.
we need to see a higher high here on this run.
Yep. And so we're kind of at a critical point here, which is I wrote over the weekend about bear market rallies and why they extract the most pain out of the market participants. So if you're a bull, usually a lot of investors get scared about piling back in after a big drawdown like we've had here for the last 15 months. And they need to see lots of green lights before they're ready to commit, right? And then finally, they get all the green lights and they put their money to work and boom, market reversal.
That's right.
And then you have the shorts, and double A, I think you can relate to this, although you practice good risk management. No, it's going to reverse tomorrow. I just hang in there one more day. No, it's going to reverse tomorrow.
It's just a relentless squeeze.
Yep. Yeah. And so eventually you go, okay, I can't take the pain anymore. Not one more day of loss. And of course, the day you take off your shorts is the day the market reverses.
That's capitulation day.
Yeah.
That's capitulation day. Yeah.
Yep. So that's when we say a bear market rally, which this very well could be, until we really get about more than 2/3 of the way back up. I know somebody I learned a lot of my own trading skills over at, what are they called? What's the guys that used to be at Invest Tools? What's the name of their new company?
Their current one is Market Scholars.
Yeah, Market Scholars. And David Settle is, I think, a really smart guy.
Yeah.
And he teaches trading for a living over there at Market Scholars. And, his contention is that until you get to basically above the 75% retracement line, it's actually a little bit more than that, like the 77% retracement line, you're still in a downtrend. So anything is a bear market rally until you get about 3/4 of the way up. And then you can start talking about perhaps a new bull market is going to emerge. So we never know where that failure point is going to be. I mean, just eyeballing this looks like it might be what do you think? 50%-ish retracement, or maybe a 38%? Kind of looks like a 38 to me.
Yeah. So, either or. Maybe looks a little more like 50 to me, but doesn't matter.
And we're about to look at some things that could either push us through or set us back here. We're going to get to that in a second before we go down the rabbit hole.
Okay.
So global stock market conditions have really kind of inched up here. Do you remember last week we were dealing with kind of the low 20s, and so it was a very bearish overall rating for global equities?
Yeah, absolutely.
So we've moved quite a bit. So the average tailwind score, remember the tailwind score is nothing more than a composite of all of these 10 factors. It's basically a point system. And these 10 factors run the gamut from actual trends. The first 3 factors are about actual trends. Buying pressure, which is money flow. That's kind of a measurement of how committed institutions are to purchasing stocks at their highs of the day into the close. And the more bullish, the more the money flow is, and the more likely that will propel stock market up. So a very bullish money flow means very high institutional involvement. And then we have relative strength, which is basically a grading system. So when we start to see stuff outperform against the Russell 3000, that becomes a thing. And then the final 4 are the market forecast oscillators, which are essentially the market's accelerator pedals. And you're able to extrapolate future price movement based on today's momentum, and depending upon how these factors 7, 8, and 9 combine, can really set expectations for future movement. That gives you a better than 50% chance of being right. There's never a perfect crystal ball in trading. And so the idea here is we kind of aggregate these 10 factors, assign them points, and then create a grading system called the tailwind score. It's really just a way to grade things on a curve based on price action. So cheat sheets is a highly technical. It's all about what's happening now. We do have another report which potentially allows us to divine what's happening in the future. So, but no fundamental data here. The idea is that institutions are the market. They all have huge research teams, not to mention their contacts at companies for insider trading. So they are the market, and we're just the minnows. We follow them along, and by using an approach like this quantitative analysis of price, we're able to be the minnows that follow the whales to the source of food.
Yep.
Now, here's the U.S. large cap fund, and it's been going up AA, but it's, as we mentioned at the outset, it's mostly large cap tech driving that.
Right.
And again, same thing, right? All these charts look the same.
Yeah, coming up on some resistance here around 420, and
yep. I still think it's a big deal that we broke through this downtrend line and have stabilized. So at least this kind of confirms the sideways pattern of the last, going on almost a year, right? I think we started going sideways in May or June of last year.
Yeah, and that was a nice back test of the break of that trend line also. So,
yep. And considering the banking crisis that is unfolding, we don't know if it's done yet, but it looks like traders are a little more sanguine about it. I suppose the fact that the government stepped in and bailed out investors, savers in that bank, regardless of whether they met the $250,000 FDIC limit or not, was probably a big reason for that. Socializing the risk, as they say.
Yep.
And that helped the market, not unlike when, one day in March of 2020, when the Federal Reserve announced a money printing scheme on the likes of which have never been experienced in the whole history of human civilization. That's how dramatic it was.
Yeah.
And of course, the market responded. All right, so these are U.S. stock market conditions, not as bullish as the global market. Overall average tailwind scores 38.7%. Above 40, we call that neutral minus, so lightly bearish. This would be solidly bearish. And then below 30, very bearish. So we have moved from very bearish to bearish. It's just really the lack of breadth and the lack of long-term market points being scored by most of these ETFs that have been pulling back or going sideways for the last several quarters.
Yeah, it's all tech currently.
Yep.
Yeah.
So one thing I'd caution about is if you wait as an intermediate trader, and what I mean by that is in our version of cheat sheet, our version of an intermediate time frame is weeks to months. Generally 1 to 3 months would be the minimum kind of hold that we would aspire to. 6 to 9 months, the maximum. Generally, when the long-term conditions, which would include the long-term trend here, the 10 below the 40-day moving average when we're bearish, and the long-term market forecast accelerator pedal or oscillator, which is here, when those two things are bearish, you're going to tend to get worse scores. But that's the months to a year or two time frame. And so while we're concerned about that, we always do better when the months, the weeks, and the days time frames all point in the same direction. That just gives you a lot more, lot fewer opportunities for a whipsaw to occur. When everything is moving in the same direction, it's great. But in a recovering market, when we're quote unquote climbing a wall of worry, it's the one time where I discount some of the long-term metrics that impact the tailwind score, as long as I'm seeing other things like money flow, or which we label buying pressure here. That needs to be strong. Relative strength versus the, as in terms of the competitive score against all other ETFs, I'd really rather see that at least neutral plus, but bullish or better. And then the intermediate forecast, factor number 8, really does need to be bullish or better. And as long as those things are there, I'm okay with ignoring some of the long-term metrics to take bullish trades that are risk managed with careful stops, right?
Right. Understood. Yep. Yeah, especially in this market, it's as you see, it's hard to find something with long-term bullishness, just because.
And AA is more of a bear than I am in terms of what he chooses to trade. But the fact is that whenever we see market conditions like this, even though we're recovering, when you got a 37 as the average tailwind score, that just automatically triggers me, cut my position size in half, and or cut my portfolio heat back, or both. And so what we mean by that is, if you're normally used to trading as many as 10 instruments in a trading portfolio with a potential of let's pretend we have a $100,000 valued portfolio. We have 10 instruments in each contributing about $10,000 to the overall portfolio value. And we make a decision that we don't want to lose more than 1% on any one trade. So if the whole market collapses, those 10 investments where we're willing to allow a $1,000 loss on each of them at a maximum, if we add up those losses and they all happen simultaneously, it would be about 10% of your portfolio. I'm willing to press the risk to that level when we're moving up in multiple timeframes. I am not, however, when we see a 37 tailwind score. So I cut my sizes in half. So $5,000 positions. I'm making this up. I'm making up the numbers to make it easy, right?
Yeah.
And then, that way, if I lose 1%, I'm losing $500 per trade instead of 1,000. Right. So that's just my automatic rule for bullish investing when I'm talking about round trips that last weeks to months. I know you probably have similar rules.
Makes sense to me.
Yeah. But you're more of an option trader, so you probably limit the number of contracts, for example.
Yeah. And even these days, I'm more of a futures and my own system for that too. So.
Well, that's tougher too, because I know that the platform you use, Tasty Trade, doesn't allow you to run stops on futures, right? So you have to babysit those.
Yeah, I mean, it allows you to run stops, but it just makes you reset them every day.
Oh, every day I didn't realize that.
Yeah.
You just have to put them on every day. There's no good canceled.
So when the market reopens at 4:30 Mountain Time here where I'm at, I have to go back in and
then that's good for the entire 24-hour. Until the market closes at 3 o'clock or 3:15.
Yes, that's
Central
right.
Time.
Yep.
Okay. Hey, I learned something.
Hey, there you go.
All right, and this has moved a little bit now. What this is basically a pay to predict market, right? It's futures, and this is the Fed funds rate. Maybe you can explain a little bit about what we're looking at here.
Yeah, it's from the CME Group, and it's basically a survey, right? From how I understand it, it's basically they're looking at market participants, people that trade in the bond market and the bond pits, and what their expectation is for the Fed funds rate moving forward.
Yep, and I think it's also derived from the trading action on the futures, the actual Fed fund futures.
Yeah. Exactly.
And so, in the pay to play market, we're seeing right now because I think the current rate target is 475 to 500 basis points, isn't it?
It is. Yeah.
Yep. So for the first time, at least in this round, and when's the Fed meeting? It's first week in May, I believe, right?
Yeah, May 3rd.
Yep. So end of the month here, we'll start getting Fed watchy. And so now more than half of market participants are expecting the Fed to sit on their hands here and pause after the quarter point that they moved last month. Now, of course, this is going to move. And I think the economic data we're about to look at starting next week is going to have a big bearing on these predictions.
Yeah, I would add it's already moving, because a week ago, I pulled it up here on my side a week ago, that number of
60.
It was 83% a week ago of no move, and now it's down to 51.
Oh, so interesting. Now, so when I looked at it, it was about 60% in favor of a hike. So it's moved even more than I thought it moved.
Yeah, they've priced in that 25 basis point hike.
So just to be clear, when you looked at it, it was 83% no move, meaning the bar to the left was 83%, or the bar to the right saying a quarter basis point.
No, so as of the week of March 24th, there was 83% forecasting that there'd be no move.
Got it. So that was the first print right after the hike, right? When was the hike? I wasn't the hike though. It was what? Trying to remember the day of the week. Was it March 31st?
I think so.
So but you're sure that was the May? That was the May prediction, not the April prediction.
Yeah,
or the March prediction.
Yeah, absolutely.
It was the March prediction, not the April, not the May prediction.
Yeah, no, it was this is for May. This is what I'm looking at for May.
Okay, great.
Yeah.
Yeah. All right. So we're all over the place on this
So
thing. So
basically,
it
the
shows
point
you
is that
how data dependent it is, right?
yeah, they're moving. It's moving around a lot.
Yep. Yep. Because we're catching it at different times and seeing different things here.
Right.
And I think we're starting to, we've been in this sort of weird lull, right? Corporations have mostly gone quiet. There's, the guidance period is over, and they're going to start to announce earnings and issue forward guidance on their calls. I think that's going to be market moving. And I don't know if bad news is going to be good news anymore. We'll have to see, because market participants, I think, are starting to get the message that the Fed may be out of bullets because of the breakage in the bank system. And so the probably the most important report next week is going to be the jobs report next Friday.
Yeah.
Right. You can't see that here because I got this ticker on here, but the Department of Labor on April 7th will release their March jobs reports. And of course, that's front run usually by something that doesn't generally do a good job of predicting what happens in the BLS labor report. But the ADP is expecting a move lower. And while I'm not showing it here, a slight move lower from 200,000-ish jobs to, I think, 180-ish thousand jobs by the BLS is what the prediction is anyway.
Okay. So
slight contraction, but still we're talking about deep into the high ones for job expectations. That's nowhere close to being ready for Fed rate cuts.
No, yes, there's still fairly robust job creation.
That's right.
Yeah.
And I think market participants are looking not just at the fact that, and the job openings, that's going to be announced this week. They're still expecting 10.5 million unfilled jobs.
Yeah.
And so we don't generally see rate cuts when 10.5 million unfilled jobs, the employment numbers are, even if they're not growing anymore, they're still high six figures, high ones anyway. And then, of course, the other data point we don't have here is wage inflation. That's going to be a big deal as well. And the fact is that we're reshoring a lot of industries, and Americans don't work for what they did overseas. So there's that wage inflation is highly inflationary overall.
Yeah, which explains some of the what do they call it, nearshoring, right? So
right, Mexico
factories going Mexico for less wages, but part of NAFTA.
Yep. And then we're not showing it here, but we think that the March CPI happens early the following week.
I'll say I just looked it up just so you know. The CPI number that's being replaced is for March is a 0.3, so pretty low number.
And that's down from what, about a 0.5 the month before?
0.5, for February February would have been a 0.5. That's right, for 2022. Mm-hmm.
And for our audience members newer to trading and investing in the markets, explain the CPI.
It's a measure of inflation on what they call a basket of goods that are thought to be everyday use. So food and energy and housing.
Yep. And they have two. And of course, the one that's called the core, the one the Fed supposedly looks at, discounts the two most important expenditures, food and energy.
Food and energy because of volatile. Yeah.
So, but basically inflation has been, there's been a couple of bumps along the road, but since last June, it's basically been, prices are still going up. They're just going up at a increasingly lower rate.
Right.
From month to month. So we need to start seeing some negative numbers here.
Right.
The Fed needs to get back down to 2%. We're still in the 5% year over year area. Aren't we? Almost 6?
Yes, that's right.
Yep. And sorry, I'm just looking at, again, these charts, not to be redundant, but just what we're looking at. There's the NASDAQ 100. So this is large cap tech, which we looked at, approaching resistance. This is the ACWI, which we looked at, the All Country World Index, market cap weighted ETF. And here's 10-year notes. So these trade the opposite to interest rates. And this is the foundational security that then determines interest rates for everything else, essentially. So the yield on the 10-year, which is we're expressing here as a what's called a 10-year note future contract, but it's essentially the price of bonds, which of course have been going steadily down here for months and months as the Fed has been doing what? Raising rates.
Mm-hmm.
And so now we're kind of at a critical point here, Double A, and put your macro hat on and tell me what tea leaves you're reading about what's more likely to happen from here. Not that anyone knows.
Not that anyone knows. I don't think what I would expect to see is kind of trading in this range. I mean, historically, the 10-year historically on average is right around 3.8%, and we're at just short of 3.5%. So I think it would be healthy, and I would kind of expect that we'd just kind of trade in this range for a while.
And so we're not looking at the rate chart here. We're looking at the bond prices, but
Right.
this would translate into that high threes interest rates, the level we're at right now.
Yeah. So, I think kind of a sideways move here is what I'm most expecting, but I don't know, obviously.
And of course, the one other sort of big thing, you're about to see where the dollar ranks from a relative strength standpoint. And I got news for you. It kind of reflects this chart where we did have a little bit of a scramble earlier this year for dollars. And so we had a little bit of a bounce in the dollar after last year's huge appreciation. But one story that's starting to, I'd say, become every year, it just gets a little bit more comprehensive in scope. But the number of different international players attempting to move away from the greenback as what's called the reserve currency, right? It's sort of the standard currency that world trade gets transacted in. And 60% of central bank holdings globally are still in the dollar. So the dollar is still a very dominant currency. But there's more and more little ways that our global adversaries and other economies are nicking away at it, right? Would that be a fair way of describing it?
Yeah, and from what I understand, particularly the oil market is settled in dollars, and that's where a lot of this is happening, right?
Yeah, Russia and China, for example, have agreed to settle their energy transactions outside of dollars. China and Brazil recently made an arrangement on their energy swaps. China's a net importer of energy globally. And of course, there's been discussions that Saudi Arabia is willing to transact a portion of its energy in non-dollar denominated currencies. So all of these things begin to build the story. And of course, for the US, which is so heavily dependent on spending money we don't have, that has profound implications in the long run, even if we are okay here in the short term, because the demand for dollars to settle trading, even that trading that has nothing to do with the US, is kind of what keeps our rates lower.
Yeah.
And if we lose that, then the opportunity to stay within our means or to live outside of our means becomes more expensive.
Yeah, absolutely.
Yep. And of course, we might do it to ourselves and default on the debt here in the next couple of months. So who knows? What's going to happen there?
So this isn't something that's imminent. Like this isn't, the world's not going to change in this regard next month, but it's just a long-term thing that needs to, pay a little attention to this.
It's a death by 1,000 paper cuts if not dealt with. And, as the Financial Times has written, prepare for a multipolar currency. So not like the dollar goes away, but increasingly the dollar will be a pluralistic voice as opposed to the dominant voice in the currency world. So now what we do is we look at the global market conditions where we add in things that are non-equity based. So this would be precious metals, other commodities, energy, also some currencies, and some fixed income bond funds in particular. And so this is probably 2 pages worth. And what we're doing is stack ranking. Again, this is all based on a quantitative analysis of price action across multiple timeframes. And, the numbers don't change that much here. It's still about equities in Europe and large cap US. But now look at what starts to sneak in here. So gold, which is something I've been trading in the form of unbalanced strangles, but I'm getting more aggressive in the types of positions in gold I'm carrying. Double A. I'm thinking about a diagonal spread here.
Okay. So your bullishness, your bullishness in gold, is at the same time bearishness in the dollar short term.
That's right.
Okay.
Yep. And here's the SPY at better than 50% closing, 60%. Lots of positive metrics here, including including the long-term forecast here, which is factor 7. If you look at SPY at 57% with a bullish long-term forecast, a bullish intermediate forecast, a very bullish near-term line, and a neutral momentum line. Those are the factors 7, 8, 9, and 10. That all suggests not only is the U.S. stock market likely to trend higher for the next month or two, but it also portends that this rally, which has been going on since October, well, we had a pullback. Okay, so that's not fair. We had a intermediate pullback, recent one at the start of the year. But the fact is that with the long-term oscillator portending potentially multiple intermediate runs, we could be seeing the market breaking through that resistance and taking off for that kind of weeks to months period. So that's the significance of this cheat sheet chart. Now, energy is the other thing I wanted to chat with you about, because you remember we still are seeing mostly weak metrics, but look at again, go to the market forecast on DBO, which is third from the bottom.
Yep.
And you'll notice that the long-term market forecast now has moved from what was very bearish to neutral plus. That is just simply a reversal of the oscillator. Again, when we speak of oscillators, we think of 0 to 100. It means that the DBO is closer to 0 by a lot than it was to 100. And the direction just simply turned up. So it went from very bearish to mildly bullish in agreement with the intermediate time frame, factor 8. And the junior time frames are not expressing any divergent opinion, meaning the momentum is not to the downside in the shorter term time frames, factor 9 and 10. It's still a long way to go. There's no relative strength in energy, and it's currently not trending. So the 10-week exponential moving average is below the 40-week exponential in factor 1. And in factor 2, the 10-day is below the 40-day in factor 2. So we haven't started trending yet, but there is the potential for a move here in energy. And we want to look at relative strength charts, especially money flow, to kind of see how near to potentially engaging energy we're going to become. And then why don't you tackle the bottom here, because you mentioned the dollar. That is smack dab at the bottom with not a lot of hope for a bullish turnaround at this point.
Yeah, no, people are giving up their dollars, at least via the UUP.
You notice what else is not part of the SPY and QQQ turnaround?
Well, small caps.
Yep.
Yeah, which I mean, we talked a little bit before we hit the go button here, and that's one of the main reasons, or that is the main reason, while I'm skeptical of this as a sustained new bull market rally, is because there's no small cap participation. They tend to lead the way, not lag.
IWC, second up from the bottom, is, I hate the fact this StreamYard doesn't have a cursor. It's really dumb. How can they not have a cursor?
Right.
But DBC is second from the bottom.
IWC.
IWC, I'm sorry, second from the bottom, and it's a micro cap. And then IWM, of course, is the Russell 2000. And I think there's also an LIR, which is another version of a small cap index. Mm-hmm. It's all kind of at the bottom here. And then mid caps are a little further up, like MDY. So the larger cap you go, the better. Mega caps, DIA, third from the top at a 28%, 26% tailwind score, does have a bullish long-term forecast, mildly bullish, neutral plus. So 7, 8, and 9 are in agreement. So that one has the potential to turn around. We'd have to climb a wall of worry because we don't have trend and relative strength with us.
Right. Also, I'll add to your point about gold on the last slide. UUP here being the last on this list just adds to the bullish story for gold, since they do move inverse.
Yep. Now, I won't go back, but the gold has, or I should say, the dollar has really traded down near a support level.
Yeah.
And well, it's not that far back. There we go. So you can see a bunch of, what do you call those candles, those little long wicks, and when they're at the bottom, they're called what, hammers? This would be an inverted hammer, I guess, right?
Yeah, they're kind of small. I can't quite see them, but yeah, I
Yeah.
mean those just long wicks at the bottom of a downtrend are kind of
Yep.
the first hints of a
Yep. So
bullishness. Yeah.
more likely than not, based on the metrics we've shared with you, more of a dead cat bounce. But that would be the reason I'm still doing these widespread trades with gold, where I profit from it staying within a range that I tilt a little bit bullishly. It's because I think the dollar will probably catch a bid here, and just bounce, because that's the nature of what traders do, right? They buy off the bottom and sell at the top.
Yep.
Or at resistance. Okay, so now what we're going to do is look at those 80 most liquid stocks that I talked about. There's actually 78 of them here. This is a relative strength rank and trend report. And this report is really the cheat sheet's secret weapon. It's what really started us, right? The other one is giving you a current snapshot of where things stand right now. This is what I like to call the Wayne Gretzky report. So if you remember Wayne when he was playing back in the 80s, I guess Connor, what's his name, in Edmonton would be the new version of Wayne Gretzky. But both of those superstars focus not on where the puck is, but where the puck is going, or where it's going to be. And that's what relative strength analysis gives you the ability to do. Doesn't work perfectly, but it's a sum of the evidence opportunity to figure out what little micro movements now could be that are relatively strong compared to other micro movements that can later translate into big diverging trends. And so we pay attention to them, but we don't pay attention to them over too short a time frame, because that can cause a lot of what would you call it? AA whipsaws.
Whipsaws, yes.
Yep. So
we've
we
seen a
like
lot
to
of
look
whipsaws
at what we
lately.
call the sweet spot, which is a 60 to 120-day trading window. But that's a trading day window. So calendar months, this would be like 3 to 6 calendar months. And when we see transitions from red to green that happen in a most pronounced way through the sweet spot, and then if they continue past the sweet spot into these shorter look back periods, then we're looking at sustained relative strength. So on cheat sheets, we've set this up to identify 3 tiers of stocks that are worth paying attention, ETFs or stocks, but in this case, it's ETFs that are worth paying attention to based on their relative strength rank in the sweet spot, their relative strength rank coming out of the sweet spot and into these shorter look back periods, and what their current trend looks like, and what their money flow looks like. So those are actually 4 different things that get weighed. And essentially, the easiest of the 3 rankings here, first of all, if you're blank, you're not necessarily bad, you're just not in play right now. Meaning you've likely already made your move, and there's still opportunities to trade in the here and now, maybe less opportunity to try to forecast where the puck is heading, because the puck has already made its decision about where it's going, or the player who handles the puck has. But anything that gets lit up in green on the right is factoring in a few things. So the lowest barrier to entry is going to be the one that just simply reads watch list candidate. It's sort of the lowest set of standards, and they are very simple. We need in the sweet spot for the stock's average rank, and that's what these numbers are. They're rank numbers. So there's almost 80 ETFs here. They just have to rank in the top half. So top 50% is criteria 1. And criteria 2, really simple, is shaken money flow. That is, I'm sorry, it's not even money flow. It's money flow above 0.1. So that means we need bullish money flow, and we need top 50% rank, and we need one of the 2 trends. Meaning if you look at the trend line and you discount the one on the far left, meaning the trend section, discount the one on the far left, we need either the long-term trend or the shorter-term intermediate trend to say up. So one or the other, doesn't have to be both. to make it into what we'll call generic watch lists. So top 50%, money flow over 0.1, and one trend or the other that's either the weekly trend or the daily trend needs to be up. Then we move to bullish watch list candidate, which basically adds the criteria of we need the trending in multiple time frames. So the 2 time frames. I'm sorry, that's not true. That's not true. It's top 50% in the sweet spot, top 33% in the period that's to the right of the sweet spot, or the 90 to 10-day look back period. Needs to be in the top third. And then the very bullish watch list candidate piles on, in addition to that, a 0.2 money flow. So it can't just be regular old institutional accumulation. It's more like FOMO accumulation. So money flow 0.2, top 33% outside the sweet spot, top 50% inside the sweet spot. And for a very bullish watch list candidate, which you don't see anywhere here, both pointing up, both trends pointing up. That's a really hard bar.
Yeah.
So the bullish watch list candidates are what we've been preaching, Double A. I mean, you can name them in your sleep, right? You've been trading them.
Right.
XLK, QQQ, XLC. Yeah. Maybe explain XLC, why we like to call that the mini-me tech fund.
Yeah, XLC communications, but it's largely comprised of things like Facebook and Google, and what else is in there? I'm blanking, but
Apple.
It's Apple. That's right. It's the same things, and it's the same things that make up most of the QQQ.
Yeah, it's like tech media, I guess is the best way to describe it.
Yeah, with a couple telecoms thrown in there.
Yeah, Verizon, AT&T are in there. And so it's sort of like a media, it's a conglomeration of media and communications, but very techy these days.
Yeah, very much.
Blended with some old, basically for those who still have a landline, the companies that do that get lumped, that are publicly traded, get lumped in there, which AT&T and Verizon both still sell landlines.
Yeah, crazy.
And then we've been talking about how the Eurozone is in favor. Well, look at Germany, EWG, that's just below Taiwan, EWT, probably about a third of the way down. You'll notice that the average relative strength score is pretty low. Actually, it's pretty good for Germany. So it's making that bullish candidate choice because it had a pretty good week this week and has huge money flow. And it's been hanging out in the upper echelon of the relative strength chart. But actually, Germany has been kind of weakening. It just never got worse than about the bottom of the top third here. So, you can see it fell down, EWG fell down to about number 27 in the 30-day look back window.
Yeah.
And then now it's bounced back. So it's been persistent with good money flow. And then at least one of the 2 trends working. So it's a watch list candidate, not a bullish watch list candidate. And then a little further down, I mean, I mentioned SPY. I ticked off all the reasons why SPY likely had a bullish future. Well, here's another one. Money flow is good. The daily intermediate trend is decent, and the SPY itself is in the top 50%. In the 30s of 78 ETFs. So at least in terms of this particular grading on the curve, good enough. And just below that, VEA, which is essentially an ex-US version of large caps. It's developed markets outside of the US.
Got it. Okay.
That's what's working. And then now there's pages and pages of this because 78 ETFs. We're not going to go through them all. SHY is short-term treasuries. So it's basically and generally the shorter the duration right now, the better the yield. Right? Have you looked at the yield lately? Is the 6 month still the sweet spot for where we're at in terms of federal interest rates?
Yeah, it is. And it's still, and the curve's still inverted against the 10. So it's flattened a little bit, but it's still the place to be.
So an inverted yield curve is where essentially government bonds that have much shorter duration pay a better return in the form of an interest rate compared to a much longer term investment. So the idea here is you get paid better for your money purchasing a 6 month security than you can a 30-year security, which is really unbelievable, isn't it? And it's that inversion
It
that then predicts recession, because borrowing costs in the short term are higher.
mhm.
And companies, lifeblood of
Yeah, it's not.
companies is loans, right? To get through
Yeah,
through payroll
it's
even.
not a common occurrence. That's for sure.
Right. And you know what? Something I don't know, I'm so dumb, is of course the yield is it's expressed as APR. But somebody asked me the other day, and I think I'm right about this. When you purchase a 6-month T-bill at a 5.5% yield, you're not getting paid 5.5% for 6 months. You're getting paid the fraction of the year that you're holding that at a 5.5% rate. Isn't that correct?
That's my understanding. Yeah.
Yeah. So you take the number of days and divide it by 360 or 365, and that will determine the percentage of the yield that you'll get. So when you see a 6-month is paying 5.5%, don't think you're tying your money up to earn 5.5% in just 6 months. It's basically the rate.
Yeah, it's annualized, right?
Yeah, it's annualized rate.
Yeah. Yeah.
And I
And the
knew
6
that,
month.
but for some reason I just went in, I just pulled a dumbass and thought, oh yeah, man, I'm getting paid 5 months in my portfolio. Well, all you suckers are. And I said, no, that's not true. All right. So finally, what's at the bottom? No surprise, other than maybe natural gas, considering, Germany just built 5 LNG um, um, conversion platforms, or maybe this is why, to make it easier for the US and other countries with natural gas surpluses to ship it over to places that don't get it. Germany's also burning lignite, which is horrific. It's worse than coal. By the way, they don't count that toward their emission systems, since it's not they don't start their day burning coal. So they start their day when it's dark burning natural gas, and then they convert to coal midday. So what they do to cheat around the environmental laws is, I learned this from Peter Zeihan, by the way. The Germany bullshits their way through being an eco-friendly nation.
Yeah.
Interesting. I highly recommend that author. He's got a book out called The End of the World is Just the Beginning. It's not apocalyptic by any means. It's actually very positive for America, but it gets into the dynamics of commodities, who makes what, and how the trend in deglobalization is going to impact countries. And also it gets into the demographic trends, what countries are aging and old. Like Russia is very aging and old. That's one of the reasons that Zeihan theorizes that Putin is attacking now, while he still has the population to do it.
Right. He's got a great YouTube channel where he publishes just very very short opinions and ideas every day, and
Yep.
I'm a big fan of that. Yep.
Yep. Something I should learn from instead of these long-winded videos. But I think this is important stuff. So
Yeah.
what's bringing up the rear double A? It's what's cause for your biggest concern, right?
It's banks. Yeah. Yeah.
Yep.
It's regional banks. And I mean,
So the data is saying don't get lulled by this market,
it
because
is,
the
'cause
banks are in trouble based on these cheat sheet numbers.
both the banks not participating and the small caps not participating cause me a lot of caution here
Yep.
to pile in and have lengthy expectations of
Yep.
continued bull trend.
So even if you're even just a free cheat sheet subscriber, know that you have an advantage at the cocktail party. If you just study these graphs, especially the bigger picture stuff that I put out on Substack and send to your email if you sign up for all access for free, you've got an advantage over anyone else at the cocktail party. Well, you've got the truth on your side, at least, because this is there is nothing here that is manipulated based on my opinion. This is just the technical trading data, and it's very common stuff. There's nothing proprietary about relative strength, about the position of a shorter term trend line versus a longer term trend line, or money flow. We combine it to try to help you make sense of it. But the data is what the data is, both in the cheat sheets trading signals report and in the relative strength ranking trend report.
You know what I find great about your data and other data services like this is it strips out the narrative, because the narrative is often a stretch. It's just the media has to tie
Yep.
a reason to an action, even if they just to do it, right? And so
Yep.
this strips all that out, and I think that's really valuable.
And I gotta be honest with you, I'm guilty of that during the midweek when I'm like, I just can't spew a bunch of charts at people. I've got to at least tell them something. And so what I do is I look and see what the market did. And of course, you can't help it. Oh, the Fed made a rate decision today and sellers came in. Who knows if sellers came in because the Fed made a rate decision? None of us know.
Right.
And we're all guilty of bullshitting each other to some extent.
A little bit, yeah.
Yeah. Okay, so we'll pick things up a little bit. Now, this is U.S. sectors and subsectors. We had shown you the relative strength numbers. This is just us stacking things from first to worst. See, there's a bunch of trading signals here. Again, it's the stuff in green, maybe the high 40s if you're discounting the long-term, factor one. Things don't look bad. And there's a bunch of other signals. So what I want to do here is just for the signals we're going to take, I just want to explain them. Okay. So this is where part of the tutorial comes in. So let's look at one here is XITK. And a reminder of what the signal is. XITK right now has what we call a stage 2 bullish trend progression. So what does that mean? First thing I'll tell you is that we're using the market forecast for that. You should also be aware that the trend progression signal does not rely on any other cheat sheet data except those 4 market forecast oscillators. So it's up to you as an investor or trader to decide which other cheat sheet factors need to be there for you to have more confidence. But clearly, and by the way, this is a light volume ETF. It's here because it's part of the S&P's subsector list to go along with their main sector list. It's basically the spiders ETFs. There are other things you could use to trade besides XITK. So just know that XITK stands for a basket of stocks, but my guess is the XLK would look exactly like this. Fair enough, AA?
Yep.
Fair enough. All right. So obviously this thing broke out, light volume though it is, to a new intermediate high. It also busted through diagonal resistance and in fact retested that and bounced, doing what I call a valley peak valley reversal. It is my favorite turnaround symbol or signal. And when it comes with some money flow and some short-term momentum that's very bullish, I love to trade this way. So it's a bust through, diagonal resistance. It makes a low, the lowest low, and then it makes a high. Usually it's a tie. It's at least a tie, if not a higher high. Then it makes a new higher low. And of course, this one didn't quite make a higher high in its first leg up, but on the second leg up, it closed the week just barely above resistance. Some would argue that it's really at resistance. But in my book, a successful valley peak valley reversal. So if you look at that lowest point, that's your valley. Then you've got your first peak, and then you've got a higher valley, and then we're approaching a new peak. Mm-hmm. And so that's a very typical way that an intermediate trend progression signal will look like. But what are the actual mechanics of an ITPS? Well, it's market forecast based. So the first thing is the green line has to be bullish. A stage 1 intermediate trend progression signal takes us from below 20 to above 20. On cheat sheets, that means going from very bearish to what's called neutral plus, okay? The green line needs to be pointed up and above 20. And in addition, and again, we're talking about a stage 1 here. What we're showing you is a stage 2. In a stage 1, your confirming signal is the blue line, which is the near-term line. It's one time frame down from the intermediate trend. That momentum gets above 80. And I've used this metaphor a few times. Think of yourself like a football team taking over on downs. When you get a stage 1 intermediate trend progression signal, you're taking over on downs, or you're receiving a punt deep in your own side of the field. And so you're starting your drive at like your 2-yard line. That's what it means to have that green line, that intermediate oscillator just above 20 and pointed north. Has to be pointed north, okay? And it's confirmed by, think of it like your wide receiver, open, deep down field. That's the blue line getting beyond 80. That's what you need to look for in order for there to be a successful stage 1 intermediate trend progression signal. The final thing is that red line can be anywhere except below 5. So the one thing that can't be happening is while swing traders are out pouring their money into something that they believe will reach a new swing high. If you have day traders selling into that and fading that, meaning the red line gets below 5, no signal. Negates it. Cheat sheets won't flash a trend progression signal in that case. Now, a stronger signal is actually to have that red line above 90 along with the blue line above 80. So that would be what we call a strong trigger. If you have all three lines cooperating, green line making a transition in the case of stage 1 above 20, while the blue line is above 80 and the red line is above 90, and that would show up on cheat sheets as neutral plus and very bullish for the two junior time frames, the blue line and the red line. All right, stage 2, it works just like stage 1, but it is probably, in terms of all the trend trigger signals, this is probably the one that provides the best potential for long-term reward with the lowest probability of a whipsaw. So it's essentially an optimized risk to reward, or reward to risk, a stage 2 intermediate trend progression signal. And that's because the green oscillator moves from below 50 to above 50. That's key. Again, like a football team, instead of being in the defensive part of the field, goes to on the offense. They're across midfield, headed into field goal range. Okay. Points are imminent in that situation. Okay. It still must be confirmed by a near-term line above 80. That would read very bullish on cheat sheets. The green lines move from neutral plus to bullish by going from below 50 to above 50. And the red line, as long as it's not below 5, that's all you need for a standard trigger. For a strong trigger, that red line, which is also called the momentum line, factor 10, gets above 90 to confirm a very strong trigger. We did not get a strong trigger, but we got was the green line transitioning from below 50 to above 50, confirmed by the near-term line. That in and of itself is a standalone signal worth taking. I always require money flow to be strong or buying pressure. And I like to have, if that red line can come along for the ride and confirm strong trigger, it's rare. That's a no-brainer trade for me personally. It's my favorite trade of all of them on the sheet. Now, there's one caution flag. I guess I'll let you take this one. It would be the indicator just underneath the 3-tiered shorter term time frames in the market forecast. What's the one caution flag here, AA, about market sentiment?
Yeah, the market sentiment tool is rolling lower and below 70, I think, is the mark on that tool, correct?
Yeah. So it's neutral minus.
Yeah.
On cheat sheets. Below 80 and above 50, it's neutral minus.
This is a great illustration for this trade, but probably should point out that on this particular ETF, volume and liquidity is probably something to pay attention to, right?
Yeah, as I mentioned at the outset,
Okay,
this would be a model for an index, but not something you'd want to trade for that reason.
Yeah, cool.
And honestly, the lack of volume could affect some of these market forecast scores. So this is for illustrative purposes mostly.
Yep, cool.
So this means the path of least resistance is not guaranteed for months on end. You get this one curling up. You potentially could have up to a 9-month run if there's quantitative easing going on. It can last up to 2 years. Neither is happening. Of course, you've got some headwinds. So tight stop loss. Generally, I do something about 1.1, 1.2 ATR, or average true range, below this 40-day exponential moving average. So that would be how I get into the trade. I'm also, I think, a little bit more, because it was such a huge day on Monday, I'm not interested in piling into this one on Friday. I'm not interested in piling into this candle on Monday morning. I'd love to see a retracement no worse than halfway back into the candle, right? And then I'd consider taking the trend progression signal. I just would like to see the market give a little bit back, but not a lot. Anything worse than half, moving halfway back down the pole would also be maybe a deal killer for me.
Okay.
All right. So that's the intermediate trend progression signal. So what we're looking at now is we've moved from U.S. sector and subsector stocks, ETFs, into a broader collection. This would be the most liquid stocks. This is a premium stack generally. But now this is where you get to see the Germanys, and you saw how strong Germany was in the relative strength chart. Now you get to see that there's a stage 3 very bullish standard trigger intermediate trend progression signal. The only difference there is that now the green line's moving from below 80 to above 80. And it just means that we're a little closer to the end of the trade than the beginning compared to that move from below 50 to above 50. That's the difference. Now on cheat sheets, what will that mean in terms of what the intermediate term oscillator looks like? It means for Germany, the intermediate oscillator went from bullish to very bullish, below 80 to above 80. And you can see that's exactly what happened in factor 8. On EWG, it's now reading very bullish. You'll see that Germany also looks like the last chart in that the market forecast long-term sentiment, which is sort of the path of least resistance in the long run, is putting a little bit of a headwind in front of Germany. Now we're climbing a wall of worry in a recovering market. So for me personally, that headwind is not enough to dissuade me from the trade, particularly because if you look over on the buying pressure column, number 4, you're seeing a very bullish indication. That means money flow is above 0.2. That's kind of as strong. I mean, it gets stronger, but that is institutions buying hand over fist. And then semis also doing a stage 3 trend progression signal. Again, standard trigger and all of this stuff, which means the momentum line is not below 5, but it's not getting above 90. But we're moving from below 80 to above 80. Again, it just means semis have been running more than most of the rest of the market, and we're potentially a little closer to the end than the beginning. Very quickly going down the trade entry signals, because we're still in the 60s as far as tailwind score goes, making these legitimate candidates. VEA is that developed market ex-US, outside of the US ETF, and the medium-term entry signal is simply a moving average crossover. The 10-day exponential moving average crosses above the 40-day exponential moving average. Many traders will trail their stop just below the 40. Others will wait for a moving average cross in the other direction to get out of that trade. That can last months. I know there's one thing that AA and I have experienced over and over again when it comes to moving average crossovers. What happens to price, after a big moving average crossover usually?
It pulls back.
Pulls back. That's right.
Yeah.
So it's not like it's an emergency to get out there and take the signal. You can watch it for a few days. I mean, sometimes it gets away from you, right?
Yeah, but
and that's the case with the SPY too. Medium-term entry signal, 10 crossing over the 40, and in both cases, money flow is there, and the momentum lines, at least in the near term, are there. So I'm more bullish on the market than I was last week. That said, you have to respect the idea that there's a potential for a reversal based on being pressed up against resistance. Right. I'm going to skip some of this stuff, but just to give you an idea of what's next here, you can make some tough decisions about Korea. That's EWI, third from the bottom. Also has a third from the top, moving average crossover signal. KWeb China, there is a reason to stay away from that one. This is Chinese internet stocks, I believe. And by the way, I've been trading strangles in that one up until this month, but I'm out. That's been a good trade.
Oh, good.
Long-term entry signal means the 10-week moving average is crossing over the 40-week moving average. But whenever you get a red light in a short-term time frame, especially if it's the danger zone, meaning that momentum oscillator, factor 10, goes below 5, even below 10 for me, that negates most bullish trade entry signals. I need to see if that signal is going to play out. Generally speaking, if you see a danger zone below 5, you'll still get the trade entry signal, but that negates it for me completely. The path of least resistance in the very short term is lower. It can be the first indicator that a stock moves from an uptrend to a sideways consolidation, but also the first indicator for a complete reversal. Now, a danger zone is just giving you a heads up. The oscillator doesn't finish below 5, but it gets really close. And that's my signal to, if I am going to take a signal that has a danger zone, a heads up on it, not a danger zone, then what I do is I never enter based on the signal at the beginning of the following day. I wait until 15 minutes before the close and see how it's played out, and just to make sure it doesn't continue to reverse. And the rest of these signals, the tailwind score is too low for me to touch, though I would make probably decisions about those on an individual basis. Anything here you're trading directionally that has a signal before I move on?
Nope, nothing here that I'm involved in.
Got it. And then as we move down the stack here, we start to think about what's really not working. And again, at the very bottom, there's dollar, there's biotech. I'm at the very bottom. There's VIX, the ETF that controls VIX. That actually finished with a danger under 10 momentum warning. Man, they're really complacent out there, aren't they?
They are crushing volatility.
Yep. So that's not a good sign for those of us. Well, it is if you sold high, then this crushing the volatility really does help you.
Yeah.
But entering a short position that relies on the decay of extrinsic value, when you're seeing danger zone readings on the VIX, it's usually a time to stay away from option selling and let the VIX bounce.
Yep.
XLF, too shitty a tailwind score to even consider taking that intermediate trend progression signal. It's a stage one, so it's telling you it's a market laggard. I just think there's way better stuff to trade out there. Why would you take a shot at something that has so many potential problems? And this is the very bottom of the barrel here, and it continues to be banks and financials and natural gas. So the theme starts to recur the more you look at this stuff.
Yeah.
You start to really get a roadmap of the market, don't you, Double?
Absolutely. Yeah. And the fact that the banks aren't participating, even though the market as a whole is discounting it, the fact that the banks aren't participating is concerning to me.
Yep. So we keep those worries in the back of your head. All right. Finally, this is a bonus for non-premium subscribers. This is really a keys to the candy store type thing. You should screenshot this list because this list represents the best of the best from a fundamental standpoint. First, I believe, don't hold me to this, but I think this is all tech, the NASDAQ 100, quantamental killers.
Yes.
Yes, it is. Okay. So it's high volume stocks with the most bullish ratings across multiple stock evaluation services run through cheat sheets. What cheat sheets is the here and now metrics. And what the watch list providers is a fundamental look. Now, something can have would you agree with this statement? Something can be really highly rated fundamentally, and it could be months before it starts to move up. And sometimes it can move down, right?
Absolutely.
So the reason that a list like this is so killer is that you're getting great earnings track records. You're getting reasonable price to sales ratios or price to earnings metrics. You're getting reasonable Warren Buffett metrics about management's performance and quarterly earnings over time, historical growth rates, all of those things that a financial analyst would consider important. What Cheat Sheets is doing is telling you that's great, but what's happening with the stock now across multiple time frames and any kind of indicator above 60, especially though 50 is in play as well, is telling you that the time for consideration is upon us. It doesn't mean trade it that day, but it means watch it closely. And so that's what this list is doing. It's a combo platter of fundamentally elite companies going into earnings and technical signals that says institutions are nibbling. And I would argue that this first list, you're seeing Factor 9 light up like a Christmas tree with mostly bullish and very bullish ratings. That means that these stocks are in play right now. And we do have some trading signals. This is a pretty big stack. And we don't start to get bearish until about the midway point. We don't start to see signals until the midway point, Double. And to me, that is a tell that some of these stocks have been running for a while.
Mm-hmm.
And the ones that are way in the 90s are maybe a little too far at the end of their run to
that
get
makes
grabbed
sense.
now. But it's this group here that's crossing the red to green Rubicon that we want to pay attention to.
Yep.
And we actually going to do the work for you. So as part of a Cheat Sheets premium membership, you get something called enhanced trading signals. So what that means is, okay, you got that signal, you got the buy the dip, you got the moving average crossover signal, you got the intermediate trend progression signal. And, I've watched some of the training videos and I've learned, what the mechanics of those trades are. But what about the rest of the cheat sheets environment? What is it that makes something, two stocks that are meeting the basic rule criteria for the individual entry signals better choices than others? And this is where we get to it right here. So I'm going to use KXPI just as my talking example here. Remember, this is tech. The tailwind score is at 60, so it's moving from what I'd call a neutral plus to as soon as it goes to 60.1, it'll become fully bullish. And that is the composite rating there. And then the intermediate trend. So that's the actual 10 over 40. this is telling you that this stock is trending bullishly now. Okay. And that's important because sometimes you can get an entry signal for something that's maybe about to trend. But for a lot of us, we much rather, because once a trend starts, the path of least resistance is higher. But if a trend hasn't started yet, there's a million things that can cause it to blow up in your face if it's not trending. So next is buying pressure, and we really kind of explain the numbers in a little bit more granular detail. So if Chaikin money flow is below 0.05, it's neutral. There's no real money flow edge. When we're above 0.05, but not quite yet at 0.1, we call this institutions lightly accumulating. That's not to be dismissed because light accumulation can easily turn into heavy accumulation, but all things being equal, you might want to consider more accumulation, meaning money flow, meaning buying pressure, all kind of the same thing. The better the score, the more likely you are to be in a sustained positive direction. So lightly accumulating versus accumulating, or what's not being shown here, aggressively accumulating, I'd always go for the highest accumulation number I can find. Now, the market forecast is summarizing where the intermediate trend line is at and the long-term trend line, meaning not the trend line, but the forecast oscillator line, and what direction it's pointing in. The one thing I want to point out is direction does matter between 20 and 80. So if something is below 20 but above 50, the difference in direction is everything. So something can be above 50 but below 80. That's kind of in a bullish range. And if it's pointed north, it's considered bullish. But if it's curled and pointed lower in that higher range, it's considered neutral minus. So just a directional shift alone in the zone can change the rating. And that's what we try to capture here. So the intermediate market forecast for this XPI is 36.55 and rising. So that's telling you it's mildly bullish or neutral plus. It's above 20, but below 50. The long-term forecast or sentiment is at 63, 65 and rising bullishly. That's a big deal. And so what you have is neutral plus and bullish. It tells me that even though the intensity of the bullish rating isn't the same, the fact is the forecast oscillators and the timeframes I care about. The one on the left, the one I trade in, the one on the right, the parent time frame, the one that I'd rather have, all things being equal, working in my favor, because they always say that, one time frame up sort of is what you want to agree with the time frame that you're at. So we've got that here. And then secondly, you'll get confirmation and two different indicators can show up. Bullish near-term oscillator breakthrough, that simply means the blue line moved above 80, telling you that from a swing trading perspective, there's a chance we could run at resistance and break through. However, the more powerful short-term reading is the momentum line. So you're not seeing anything about the momentum line here, telling you that the momentum line is neither bearishly weak, nor is it bullishly helping you. So that shortest term time frame isn't in play. That's not a problem. Remember, momentum hurts more than helps trades. Overall, the grade is B, and it probably would be A, except the tailwind score is not quite above 60, and the markets, based on our analysis, is still below in bearish territory. So that's why the B rating.
Okay.
KLSE, slightly less bear rating. And the difference is the long-term forecast. That knocks it down a grade. And then it will also tell you the entry signal. I've explained each of these two. This one I haven't explained, CEG. You wouldn't trade this, not at a 29, not with bearish tailwind scores, light accumulation. The forecast oscillators agree with one another. And the near term is breaking through. I guess this is a D level. It's subject to failure, but I guess it's worth a shot, right? It's not a no-no.
Just risk management.
Yeah. I'd probably look at something a little higher rated before this one. But the 21-day rising signal, let me tell you about that. Just two things that are required here. The 21-day exponential moving average needs to be pointed up, and price needs to move from below it to above it to trigger that signal. That's it. So no other cheat sheet metrics factor into that signal. If you see that signal, you definitely want other things at your back. And I would say the most important of which would be some money flow. at a bullish level or higher.
Got it.
And then this will just give you, and again, if you're a premium subscriber, you've got all this in your inbox. This is a moving average crossover for KXPI. 10 is crossing over the 50. Maybe, why don't you, I mean, I'm sharing my stop loss system, which is to take the moving average that makes the most sense and stick a Keltner channel trailing just below it. In this case, I'm 1.1 times the average trading range of this stock over the last 40 days. And what I do is I stick that below the moving average, and then this dotted line represents that number. So it's what we call a volatility-based stop.
Mm-hmm.
Sometimes, you've also used percentage stops, haven't you, Double?
I have, yeah. And they're some people don't agree with using percentage stops, but it makes it easy for me and defines the risk, and that's really what I'm trying to do.
Yeah. And there's no great answer here, but you just kind of want to look at the history of the stock. And if you see that light volume pullbacks cause things like this to occur, now this is of course in a downtrend, so I'm less concerned about it. But if you see whipsawing back and forth in the context of an uptrend that sticks you out of the trade, you can always widen the stop loss and just lower your position size. So some traders would say, don't use that dotted line, use the trend line and just put something kind of just outside it. And that's a valid stop loss strategy too.
Yeah, it's whatever you're comfortable with, right?
Here's the KLAC trade. Very similar looking chart. Again, valley peak, valley reversals, wall of worry that you're climbing. You want to pick the best one with anything where you're below a major resistance. You want to just pick the best set of metrics to help power it through resistance. I like to see very bullish money flow when I'm down here. And we don't quite have that. We have bullish money flow.
Yeah, not quite there.
All right, so this is quantamental killers from the Russell 3000. So there might be some repeats in here, but we do change the standards a little bit in terms of volume. This list ends up being way shorter. And I'm not going to go through the list here, but the same criteria are applied. And you can see pretty much with this elite stack, just about everything is green lit across the board with very few exceptions. So these are in play. And you got 2 A's among them and a couple of B pluses. Actually, of all these trades, Double, the one I like the best is Decker's Outdoor.
Okay.
Now we're going into earnings, but we have that combination of bullish tailwind score just above 60. We only have light accumulation here. Yeah, that's a drag. And we only have we do have a long-term headwind. I guess AME is actually the better looking of the two. On a comparative basis, also a better tailwind score. But I'll show you what I like about Decker's beyond metrics that sort of get you covered is actually, you know what? Maybe it wasn't Decker's. Maybe it was AIM. Oh, no, here's Decker's. Yeah, it is Decker's. So the reason I like Decker's is it's been in a very long sustained uptrend. It's in fact doubled in value. I don't know about you, but the buy the dip signal that has triggered this, it's only been a 3-day pullback. Still seems kind of far away, even from this moving average, which is a short one, right?
Right.
I'm more likely to maybe let this one get back closer to the moving average before I pull the trigger.
Yeah, I mean, it's riding that upper volatility band. Yeah.
And the other quantamental trades, these have all been running a longer. The trend is well established. Maybe this is the one I was thinking of. This is an A grade, which means you've got all the factors working for you. And the reason I think I like this one is because it bounced off the trend line just on Friday. So your reward to risk is potentially great. Now that was a big candle. Earnings are in front of it. You might benefit from a retracement. And the reason I actually like this one the best, Double, despite the fact that there's some long-term resistance immediately overhead, is I can sell covered calls while I wait. And going back to this signal, the institutions are accumulating shares at a bullish level. So I've got money flow on my side. With AIM, I've got aggressive money flow. AME, A rating, everything working in its favor. So maybe we look at AME. That when you have very bullish money flow, I'm not afraid to trade for a potential resistance break. Meaning there's your resistance.
Yeah, and
Here's the move. Now
Friday.
it is, we're on like the 5th or 6th up day. It's probably not the best
Yeah.
entry. We use some common sense, along with the cheat sheet signals. But I'm definitely, I think a sold put here, if you can get out before earnings, or a risk-defined call spread that maybe actually takes you through earnings, either one of those could be good ideas.
Yep.
All right, that's a lot.
Yeah, that was good.
What's now that you've had a chance to digest, are you more likely to throw a sold call spread on banks when you get to work on Monday, or are you more likely to dive in on something techie that's breaking through a resistance?
Mike, honestly, I've been mostly on the sidelines here just because it's been so choppy.
Yeah, it's very choppy.
The indices have been so choppy, and I have a suspicion that the bank thing crisis,
It's not done.
I don't think that's done, and I think that the bank indexes are telling us that. So I've mostly just been being very cautious and sitting out here.
I'd say I'm trading for engagement, but I'm with you. I mean, I've got a sizable chunk of my long-term stuff actually in a short-term actual T-bill, yielding 5.5. And in June, that's when it expires. That's where I'll make a decision about whether to dollar cost average back into the market or re-up a T-bill.
Yeah. And
also, I'm with you. I think that there's some precariousness here, but usually when the majority of people are precarious, the market goes the other way.
Right. And the fact that it's tech leading the way and it's gotten kind of silly in my view, how tech has moved. That's also, another reason why I'm just backing off.
And basically tech has been the bull market leader since March 2009.
Yeah.
So generally speaking, you come out of a market cycle and you start a new one. Generally, the yesterday's leaders don't lead the new rally. But there's also some interesting things in Zihan's book about why tech progress is likely to be capped during the next decade of reshoring. And it has to do with some of the natural resources that are necessary for the production of semiconductors. And it's a really weird list. So, for example, you don't think of neon mattering, but neon is basically 75% of the neon market is Russia or Ukraine.
Yeah.
And basically neon is disappearing off of the global supply chains. Well, neon isn't used in building semiconductors, but it's used as part of the focusing apparatus for that Dutch company that makes the thing that creates the laser that etches out the semiconductor electrical path. That's the layman explanation. So you might not think neon is that important, but it's incredibly important.
It creates a bottleneck in the manufacturing process.
That's right.
Yeah.
And you start looking at some of the exports out of Russia and Ukraine. Russia was a very small, in the early 90s, Russia was a gas station and an oil well, but it didn't exploit its natural resources. Well, things have really changed in the last 30 years. And it is a key exporter of a lot of stuff. Not that we can't find it where we are, but it's a tougher putt to start digging stuff up in the United States, right? There's a lot of pushback against that. Russia, they're free to do it, right? Move over, citizen. I need you as cannon fodder. It's Ukraine, and I need your house to grab some nickel out of your yard.
And also on top of that, I mean, so talking about the natural resources, now the federal government has laid in place, especially when it comes to EVs, is really what I'm thinking about. They've laid in place demands that those raw materials have to come from countries with a trade agreement with the U.S. If the end result, if that end product is to be have any sort of tax incentive applied to it. So they're not only looking for rare materials, but kind of tying one hand behind their back as they dig.
Creating impossible Venn diagrams.
Yeah.
Yep. No question. Well, that's a lot to take in. And so I think we'll call it a day. My name is Mike O'Connor, my trading partner of well over a decade. Aaron Montel, we started out in radio. We learned how to trade and invest because the business of radio just sucks and it's getting worse.
Yeah.
And so we've learned to take our financial matters into our own hands. And I'm actually, associated with a radio-oriented company that may not be. It may be that I'm retiring here soon. So
yeah.
well. Stay tuned whether I become a full-time trader. Right now, I'm a full-time, part-time trader.
That's right.
Feels like full-time, though.
And cheat sheets curator.
Yeah, you got it.
Yeah.
Hey, Dubs, thanks a lot for joining me today. We'll see you again next week.
Yep. Thanks, Mike.
All right. And to all you out there, www.stockcheatsheets.substack.com.
Thanks for watching. Become an all-access member at stockcheatsheets.substack.com to get free trade entry segments delivered to your inbox.